Have you ever wondered how interest rates affect your ability to buy a home? While it may seem like a complex and intimidating topic, understanding the link between interest rates and home affordability is crucial for anyone looking to purchase a new property. In this guide, we'll decode the code behind these two key factors and explain how they work together to impact the housing market. Watch to the end as we're going to crack the code and decode the relationship between interest rates and home affordability. First things first, what exactly are interest rates? Put simply, interest rates are the cost of borrowing money. When interest rates are low, it's cheaper to borrow, making it easier for people to buy homes. But when interest rates rise, so does the cost of borrowing, potentially making homes less affordable. This is because higher interest rates mean higher mortgage payments and less purchasing power for buyers. But how do interest rates actually affect home affordability? To understand this, we need to look at the concept of housing affordability. Housing affordability refers to the relationship between a household's income and the cost of housing. Generally, when interest rates are low, housing affordability improves as people can secure lower mortgage rates and pay less interest over time. This can also lead to an increase in demand for housing, driving up home prices. On the other hand, when interest rates are high, housing affordability decreases as people have to pay more towards their mortgage payments and have less disposable income for other expenses. This can also result in a decrease in demand for housing, leading to a decline in home prices. But why does this matter? Let's say you're shopping for a home with a budget of $250,000. With a low interest rate, you might be able to secure a mortgage and comfortably afford the monthly payments. However, when interest rates rise, the same $250,000 home may now require higher monthly payments, making it more challenging to afford. The monthly payments are the key. That same home buyer with a $2,000 a month mortgage budget may be able to afford a $300,000 home when interest rates are low, but only a $250,000 home when interest rates rise. This is because the higher interest rate translates to a higher monthly mortgage payment or less purchasing power, as a higher percent of the $2,000 will go interest. So how do interest rates affect home prices? When interest rates are low, more people can afford to buy homes, increasing demand. This surge in demand often leads to rising home prices. Conversely, when interest rates increase, demand may decrease, and home prices might stabilize or even decrease. Now you might be wondering how interest rates are determined. Interest rates are influenced by various factors, including the state of the economy, inflation, and government policies. The Federal Reserve plays a crucial role in shaping interest rates by adjusting the federal funds rate, the rate at which banks lend money to each other. Changes in this rate can ripple through the economy, impacting mortgage rates. Understanding the link between interest rates and home affordability is crucial for anyone considering buying a home. By staying informed about interest rate trends, you can better plan your future and make informed decisions about when to buy. Thanks for watching. We hope you found this video helpful in decoding the relationship between interest rates and home affordability. If you enjoyed it, don't forget to subscribe to our channel for more informative content. Have you ever wondered how interest rates affect your ability to buy a home? While it may